everybody. Welcome back to our weekly podcast. My name is Patrick Tan, General Counsel for ChainArgos. With me, as usual, every week, our CEO and Chief Data Scientist, Jonathan Reiter. Thank you for tuning in. Thanks for all the likes, comments, and subscribes. We appreciate it. And, of course, all that inspiration for future episodes. So what are we going to talk about this week? I know everybody's talking, making a big hullabaloo, such as it is, on the Tornado Cash decision by the Fifth Circuit. We're going to go into that a little bit. And then, of course, we're going to talk about, in the same vein, Tornado Cash's co-founder, Roman Storm, and some of the interesting things that he's been up to whilst out on bail.
It's a sister company. Anyway.
Pretty sure it's a bail condition violation. But anyway. And then finally, a little bit of MicroStrategy action. But before we begin, we're just going to duck down below and take out what's already been done for you. We went through this. That's why I have my glasses on. We both went through the United States Court of Appeals Fifth Circuit decision. That's over here. For the OFAC and Tornado Cash. And basically, long story short, the court decided that the Department of the Treasury and the Office of Foreign Assets Control may have kind of overstepped by sanctioning the Tornado Cash smart contracts themselves. Obviously, the crypto bro community has celebrated this decision as a win. I do question, and please interject if you find this unreasonable. I read this decision. It is 34 pages, double space, pretty big font. Not a whole bunch of stuff to read. I am not sure if this decision says the things that people seem to be celebrating. I'm not sure if that's
it very clearly says that the government can't, sanction unownable stuff because it's not ownable. It isn't owned by anybody, so it's not within the meaning of the whatever law property, that's clear. It definitely says that.
Yeah, definitely says that.
I think the questions are around what it says you can sanction, and it actually goes into, I think, unnecessary and excruciating detail regarding how parts of the system were owned by people for various periods of time.
So a bit of backstory. If you haven't been following the Tornado Cash stuff, Tornado Cash was subject to OFAC sanctions because it had been acting as a mixing service for some not so nice people. Fine, whatever. Now there was a period of time when Tornado Cash was centrally controlled.
Well, yes, let's just do that. So the contracts were first deployed in late 2019, and for a period of approximately 6 months, they were completely ownable and owned and centrally controlled and administered as per their own writing.
Yeah.
There's no dispute about that. As has been pointed out several times, the court is a little bit confused in how it describes the process by which ownership was given away. You can see the transaction that removes ownership and the ownability, and for about a 6-month period, there's no dispute, I think, at all that the system was centrally owned and administered by some folks. There's then a period of around 2 years where the system had a relayer network that was essentially centrally operated. It was and run by affiliates. And whether or not the relayers are exactly involved in custodial money transmission is one question, but even the documentation for relayers, particularly for this period, made clear that there were risks associated with this, and a relayer is just a piece of software you run on your own computer. So there's no consensus process. There's none of that. So again, this is about a 6-month period in which the system was completely centrally controlled and owned. The judges go through this in some detail. And then the relayer network, and again, this is described in their own documentation, for around a 2-year period, unquestionably was just people individually deciding to participate in making this process work. So those were definitely owned and ownable because you just ran a Docker container, whatever. You ran some code on your computer, not a blockchain node, nothing like that, just a program. And then a process was put into place that allowed that to be a little bit more decentralized, but components of the relayers are still ownable software run by individuals, right? So the courts have said Well, okay, you want to go through this, and then I'll come back and summarize that one.
I will read the exact findings. Mind you, 2 out of 3 of the judges on this case were Trump appointees. On page 22, the judges say the immutable smart contracts at issue in this appeal are not property because they are not capable of being owned. Okay, more than 1,000. Blah blah, and then they just go on about
sorry,
how,
to be fair, they should say no longer capable of being owned.
Yeah,
Anyway,
they were capable. They were owned.
Yeah.
And then now, right now, they are not capable of being owned because, well, they revoked ownership. But what that does tell you, though, is that, and again, this is not binding precedent because that's not what the court had to decide at that stage. But what this seems to suggest is that if the smart contracts at issue are mutable and are currently owned, then they may potentially be subject to sanction because it is property and it has a capability of being owned.
I don't think there's any dispute that property that's owned is possible to sanction. There's no dispute about that. The question here is whether or not this counts as yeah.
So one of the things that I was confused by, because I've seen a lot of celebration about this in the Twitter spaces, or X, sorry, is that this is a pushback against regulatory overreach or administrative overreach in this case. No, not quite. I mean, to me...
Well, I mean, in some sense it is because the government tried to do something and got told they can't do it. So in a formal sense, yes, it is.
Yeah, in a formal sense it is, but it's not meaningful anyway. I mean, you can't sanction something that is basically a runaway trader at this stage.
Well, so, okay, and then to get back to what I was saying, I think as the relayers are clearly ownable and owned, actions with respect to the relayers, sanctions, criminal, whatever, are all clearly inbounds.
Yeah.
There's no discussion that things that are ownable or owned, right, are not subject to the rules as usual. The system consists of a number of components, some of which are at various points in time to different degrees, decentralized or not, and some of which have never been decentralized. The judges actually, to my reading, go into unnecessary, excruciating detail regarding the parts of the system that were and should be subject to whatever legal action or could be subject to legal action, as opposed to just saying that this one section isn't subject to legal action. They even say they think, to some extent, they feel like the conclusions are like unjust or wrong or whatever. They don't think it's right, but the law clearly states that stuff has to be property to be subject to these rules. And they seem to be trying to point the prosecutors at the case that they should make.
Yeah, it did feel like they were trying to frame the case for the prosecutor. And
I mean, there's graphics and whatnot in here. It's really incredibly detailed for a...
Mind you, this is the Fifth Circuit. The Fifth Circuit covers, I think, parts of Texas, Louisiana, some bits in the south, near the border of Mexico. It's interesting because they make very specific statements like, first, Tornado Cash doesn't profit from the immutable smart contracts at issue in this appeal. But that also suggests that if they did, there could be issues.
I would note that the relayers do.
Yeah, and they do say that. Some relayers and token holders may receive fees from using the mutable means somebody controls it, relayer registry smart contracts, but not from the mutable pool smart contracts. The department has failed to provide us with evidence that any blah, 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 and the rest of it goes on.
Well, that's about whether it's foreign owners or sanctioning. So there's two separate issues here. One of them is that you can only sanction certain type. They have to be foreign entities, foreign people, that kind of thing. They can't sanction Americans directly. So you have to establish they're foreign. But that has nothing to do with whether or not the government can take legal action against the parties that own the relayers, right? So you can't OFAC an American, but you can definitely prosecute them for dealing with, whatever. Anyway.
And it's interesting as well because they go into an example which I think is relevant to future cases. Watch this space. About control and custody. So I'm going to read you this thing from page 28. For example, if a mixer was mutable, or in other words, controllable, or custodial, and they use all these terms interchangeably.
To be clear, it does not say controllable and custodial.
Or. It says controllable or custodial. The mixer's operator or owner could offer to mix deposits, which a third-party user could accept by transferring Ether to the operator's mixer smart contract. The operator controlling the smart contract would use the mixer smart contract to fulfill the contract by taking control of the third-party user's deposit, mixing the third-party user's deposit with others in the pool, then withdrawing the deposit to another account as determined by the third-party user. In that case, someone is always handling the Ether. So
That someone would be whoever has
the
control
the
or
mutable
custody.
smart contract.
Control or custody.
Or custody. So this tells me that if you have, and again, not binding precedent, because the court was not asked to determine these issues in this case, because they're just not brought before the court. But this seems to suggest that if these issues were brought before the court, like let's say for instance you could show that, hey, this wallet software or this mixing software or some kind of software had admin keys or even routing,
Control or custody.
or custody. Like let's say for instance it had control or custody of where the user's crypto assets go for execution, for instance, for a trade or a swap. Technically, you're in control or custody, and you could potentially be responsible for whatever the consequences of those actions were.
Yeah, it's certainly not a blanket exemption for contracts that have administrative controls. There will presumably be cases laying out what administrative controls do and don't count.
Yeah.
Whether or not adjusting a fee level from 0 to 30 basis points, that's not a random example, qualifies as that level of control or not. It's different from whether or not just arbitrary ability to do anything and take people's money. So we'll see.
I mean, if nothing else, I feel that this decision clarifies what I've always suspected might not be so cool for a long time, which is that if you've got admin keys, if you can route where all the assets go, you're in control or custody.
I also think you might see the charges amended again in line with, the judges really sort of provided a handbook for the prosecutors, which is weird, but.
And they make this distinction, and this is at page 31, sort of towards the end. Indeed, those laws do not recognize the difference between mutable smart contracts, in which there is a party controlling the software and thus a party with which to contract, and immutable smart contracts, in which there is no party with which to contract. So the court has actually made some progress in terms of helping to define and shed light as to what the meaning of mutable or immutable smart contracts is.
And if something is automated, there are questions as to whether it's automated and updatable or changeable or mutable or whatever or not. There are degrees of automation that I think lawyers aren't so familiar with how computers work. So there you go.
There you go. So, but the judges actually mention the term upgradability many, many times throughout the judgment. And it would seem that if you are operating some kind of scheme with an upgradable proxy contract that you still hold the admin keys for, you could potentially be taken to task.
And you're unlikely to be able to declare that it's not upgradable. It's just some routing table update or, exactly what amount of power is going to require some litigation.
Yeah.
So we'll see. This is actually another wonderful example of how regulation through enforcement works great, because you end up having concrete examples, details worked through in painful detail so that you can explain what's going on and reason by analogy, as opposed to contrived cases that are a bit too extreme in either direction.
Now before you guys start hitting us up on Twitter, which I know you will, and sort of saying disagreeing with us to say that this is a huge success and win for the crypto industry, I would suggest that you perhaps read the decision first. That's.
I think actually, to the extent to which people misunderstand that, the problem is that they believe a lot of things lack admin keys and are decentralized because it says that on the website, but in practice they aren't.
Yeah, in practice, a lot of this stuff
and things that process 9 figures for North Korea get a lot of detail and investigation, and until the cookie cutter process is put together, you're gonna need a few cases litigated to figure out where that line sits.
So and then, this isn't that saying that all smart contracts and everything that's decentralized it's sort of free for all because nobody's responsible. I do agree. Before you start thinking that we disagree with this decision, I actually agree with this decision. I think it's the correct one. I mean, there's no point to sanction something that you can't stop anyway. What's the point of that?
The court does not do anyone any favors by issuing an order that no one can make sure is enforced.
Yeah, there's no point. Like, okay, so even if you were to sanction
this has been our position consistently for several years.
Yeah. So even if you sanction a smart contract that nobody controls, you can't shut it off.
No.
So what's the point? If nothing else, because you sanctioned it, now you open up the possibility that people could be subject to ransom attacks by running stuff through the Tornado Cash contracts. Now it's because it's OFAC sanctioned. Look, I'm gonna run a whole bunch of money through through the Tornado Cash smart contract, which is sanctioned. Send it to your exchange unless you give me pay up the ransom.
Okay, there are procedures anyway. Okay,
But you could do that. I mean,
okay. So that we can then turn to a service whose exact terms we can look at quite closely here, run by one of the Tornado Cash founders. So this is Roman Storm.
Yeah.
So this is Multisender. So we published a little bit of material on this. So let us start here. So this is just flows through Multisender's most recent main address. Let me go through this in too much detail. But you can see here the Multisender does some kind of real size. So whatever's going on with Multisender, there's millions of dollars and stuff here. There's a much longer tail of small size recipients here than there is in the sending side. That's why the amounts are a bit different. But whatever. So this is a service that allows you to send it roughly a CSV file with a whole bunch of different recipients, and it'll spray the tokens out to all those people at once. Gas optimization, whatever. So it's a very simple service conceptually. Nothing fancy going on from a finance point of view. It's a software, whatever, optimization type thing. So this is a service that in its current incarnation is closed source, but for which we can get the source for much older versions. So it raises a number of interesting questions directly related to this Tornado Cash ruling. The first of which, I guess, is whether or not any of these protections don't apply for closed source services. One would imagine the government can sanction a closed source service because there's no way to prove it can't be owned. Right? It's interesting. Right? The only reason you can tell if Tornado Cash can be owned or not is because the source is public and verified. Otherwise, you'd just be guessing. All right? Yeah. So I guess the default position has to be an assumption of ownability, maximum subject to the law for things where the source code isn't readable, because otherwise you can just publish stuff without the source code readable and you're bulletproof. All right? I mean, if Tornado Cash closed source meant that it was exempt from sanctioning, that's absurd.
Well, it's interesting. If that were the law,
it doesn't feel like that could be the rule, and then just you'd publish everything closed source and nobody would ever get in trouble, right? Which is a bit nuts.
If that was the law, I think we would have to change and relook at how businesses run.
So what we're going to take a look at here is a few features of Multisender, and then we're going to talk about how this interacts with the sort of control concepts here. So for those of you who are familiar with the technical details of how upgradable proxies work, this may be a little bit too slow. For those of you who aren't, maybe a little bit too fast, whatever. So the way that you build a proxy contract in general, right? So this is a contract that receives function requests, function calls from somebody, and then forwards them on somewhere else, right? So in the system, what you end up setting up is a fallback function. This is the thing that gets called if it doesn't know what to do. So if I try and call function X on Patrick, and Patrick doesn't know what function X is, it calls the fallback function, passes it along. And what you're seeing here is the fallback function for Multisender's proxy contract. And the first thing to notice here is that there is an administrator, right? And the administrator in this case is a known address. This older version of the code is open source, so someone has administrative control over the system, and you can see what that administrative control is here because of the very complex, frankly, fallback function. These are normally really simple functions. So you can see that it can upgrade the system, upgrade and call. It can change the admin. It can do stuff with the admin, and it can change the implementation. So the admin has the ability to change what the system does, upgrade the whole system, upgrade and call whatever the system, and change who owns the system. So that is as close to total control as you can imagine. I mean, it can do basically anything. There's no restrictions on what happens here. So that's interesting. And then we got to look through here. Okay, so the next question is, Multisender has a web front end. So the way the web front end works here, and anyone who's done any sort of transactions with a web wallet's familiar with this, you end up having, you have to approve signing requests. You have to approve transactions. So this is the piece of code that develops the approvals, the approval requests. And the important line here is this one. So the way the system is set up, it generates approval requests by calling approve on the underlying token, and delegating, the approval is to give control over them to the proxy sender address. So the contract we just saw, over which someone has total control, is handed your tokens. And the way the app works is you sign a request that sends your money to that piece of code. All right. So in this case, this is an older version of the system. The code is open source. In theory, you could read what it did. It could be changed at any time. Could be changed at any time. And then subsequently, and there's a table further up in this draft somewhere that shows that the implementation was updated repeatedly. So what you've got here is a situation where someone is actively exercising administrative control over parts of the system. And the way you do it is you just hand them your money and you also send them some instructions. But those instructions don't bind what they do with your money. And this is something that a lot of people seem confused about here. When you sign a transaction, you can sign a transaction that says, here, take my money. And also here's a blob of code, here's a blob of instructions, just a blob of text telling you what to do with it. You can also construct scenarios in which what is signed somewhat restricts what can be done with it. But maybe you can restrict sometimes, not other times, whatever it is. In this case, there are other examples we're not going through today that we're indirectly referring to. There isn't really any restriction on what can happen. You're just blindly handing it off and hoping for the best. Right? So here, for example, what you see is this multisender approval to spend the amount of the token, the symbol for the token, right? The amount of the symbol. That's it. So you're giving it approval to do what it wants with that amount of your money. Okay. It's not clear. I mean, under the standard we just discussed, it would seem as though the guy with those admin keys might have some control, right? Okay, those are just more screenshots of the same thing, sorry. So the question that this naturally raises is, if the system is closed source, if you can't read any of those things, right, who has control? Here, we have an interesting corner case, right? So we just discussed how if the system's totally closed source, the law is going to have to assume that whoever put it out there has control over it, because otherwise it's a total get-out-of-jail-free card. Here we have here we have an interesting case where the proxy is open source, and then sometimes the implementation is closed source, sometimes it's not. So we can tell that someone has ownership, and we can see them exercising that ownership because of the tiny slice of the system whose code we can read, and then we can see there's a dark section over somewhere else. Right? So where do we think this falls with respect to those types of control rules? Again, I would assume that the default position is going to be, if we know you have control and you direct the money to a dark thing that you also deployed, whatever, that you have control for purposes of the whatever earlier discussion. Was it custody or control?
Custody or control.
Now, this isn't completely litigated out yet, right? So we don't have a full set of tests for all these cases, but it feels like that type of thing isn't going to be ruled in bounds because the judges are already intimating that it can't be ruled in bounds.
Well,
right? The only thing that's out of bounds is the immutable, unowned. Yeah.
I mean, just think about it from a high-level, simplistic perspective. If it's a black box, if you send your money to a black box, whoever controls the black box is in control. Think about it like when you invest with a hedge fund.
Well, they may or may not actually be in control, but the presumption has to be that they are.
Correct.
Otherwise, using a black box is a get-a-jail-free card.
Because think about a hedge fund, right? You don't necessarily know the strategies they employ. You don't have an idea as to the securities that they trade. You don't really know exactly what their positions are at any one point in time. They're literally the definition of a black box when you invest in a hedge fund, and you trust them. That's why they're regulated. That's why they have auditors.
Yeah, that's why money transmitter laws exist. Why all this all this stuff exists, because those types of trust relationships are asymmetric, and this is intended to resolve that information.
So when you palm off your money to somebody that's running a black box, typically the law says it has to be regulated because that person who controls the black box is in control.
Yeah, I mean that seems to be the default
Not unreasonable
position. Yeah. Custody and control.
Custody or control.
Custody and control are the things that matter here,
Yeah.
and it isn't necessarily necessary to have both of them. So we'll see. It's interesting because we're now. I mean, this ruling is really very detailed with respect to the functioning of DeFi, so it'll be nice to see things.
I recommend you read it before you start celebrating. That's all I'm saying.
And it's also worth then going back and reading that Rettig, Mosier, and whatnot paper, and then seeing some of the old DeFi recent hearings, where all the exemptions everyone's asking for are with respect to immutable, unowned, unownable open source code.
Yeah.
And
That
there's
seems reasonable.
nobody advocating for any kind of exemptions and special treatment for things that don't meet all those tests.
Yeah. I think that's probably more useful than how we test in some cases. Anyway.
It's probably clearer, right? So the clearest version of the system is it needs to be unownable and open source. You need to prove it's unownable through the open source.
Yeah.
Otherwise, you're totally in bounds. And
Yeah.
frankly, while that seems like a very aggressive test and very, very limited amounts of control maybe should be excluded, that's the simplest one for the court to come up with. If you're saying, the ability to adjust the fraction of fees between, again, 0 and 30 basis points,
I might give you a pass.
you're going to need a whole complicated framework that looks like the Howey test again
That's
for
right.
working out what degree of control there is
if,
there.
if the only thing you can control is the fees, although that having been said, one of the things that the Fifth Circuit also said is that if they had received fees from it, because you can't be seen to be benefiting from the proceeds of crime.
But look, a fee switch that goes from 0% to 100% of the full amount means you can take all the money. So anyway, it seems to me like an extremely simple black and white rule is the easiest one to enforce, but we'll see where it goes.
All right, finally, MicroStrategy.
MicroStrategy is interesting. So what I find amusing here is that MicroStrategy what he's doing is very clever. It's very, very clever. So ignore MicroStrategy's underlying software business because
it doesn't exist.
no, I mean it's not a meaningless business, but compared to the size of their operation now,
fair
anyway, they're a couple $100 million in revenue. They don't make that much money relative to that. Whatever, if they've got tens of billions of dollars in Bitcoin cash flows related here. So what you've got is a situation where the stock is trading at a massive multiple to the assets inside the company.
Fair enough.
Right, and so the people that run the company are saying, if you're willing to pay 3 times our assets for our stock, we'll sell you as much stock as possible and use it to buy more assets.
As for me, I like the stock.
I mean, eventually, as they keep selling the stock,
of course,
those things will come in line with each other, which is fine. Companies routinely sell stock when it trades way above their assets and buy it back when it trades below their assets. That's all fine.
Wrong. Yeah.
There's nothing wrong with that.
Yeah.
In this case, instead of issuing stock, he's issuing some stock. He's also issuing bonds. And instead of paying interest on the bonds, he's handing people equity warrants, options to buy the stock at a higher price. Okay. I mean, that's fine, right? 5-year, 50% out of the money. It is interesting to watch that happen. What that does, assuming these are just intended to be paid via dilution, so they're warrants. You sell a whole bunch of really high strike warrants, high strike options as a company that's issuing the stock. It means that if the price goes up, you'll just automatically issuing into those options for people, and there's an amount of stock at which the price will stop rising. I don't know what that amount is, right? But the more sellers there are, the less likely the price is to go up. So if he sells an infinite amount of stock, the price will stop rising. So that's what that mechanism is. It seems as though when that premium to the underlying assets drops, all those options are going to be wildly out of the money.
Yeah.
All right. And what is interesting here is to see if you model MicroStrategy just as a bunch of Bitcoin, you can work out, 50% out of the money in 5 years is a Bitcoin call struck at 1.5 times the current Bitcoin price. But because MicroStrategy is trading at 2, 3, whatever times the underlying assets, it's not 50%, right? It's 50% over 2 times the current price. All right. So it's a very expensive way to buy that exposure. But at the same time, the multiple that MicroStrategy trades over its assets can move over time. So if you buy those options at a multiple of 3 and the market piles into these things and the multiple goes to 4, you're still up money.
Yeah.
Eventually, the multiple will fall to 1. It'll drop, right? Multiples go up, multiples go down, whatever. MicroStrategy was trading way below 1 at one point. Whether that happens with the Bitcoin price sufficiently higher or not will determine whether or not people make any money, because the underlying eventually will converge to the price will eventually converge to underlying. But yeah, in the interim, it's fascinating to watch. Given the market cap is now on the order of $100 billion, so that means that, say you're trading at twice NAV, twice the value of the underlying, that means $50 billion of market value are this multiple. And the question is, how many dollars can be taken out of that before the people driving that multiple lose interest? Right? Because there's not an infinite amount of money willing to pay twice NAV for this thing, and he's clearly willing to keep selling.
Well, that's the logical thing to do as well. I mean, if everybody's willing to pay that multiple for the underlying, I'll sell everything I can. Souvenirs, hats,
there are
T-shirts.
Some interesting connections here, both with the Tether minting that seems to be happening around similar times and the history of GBTC, where Grayscale was engaging in any transaction it could to get more Bitcoin into the trust because it collected fees on the trust.
Yeah.
And it looks perhaps like some of what's happening here might be Tether attempting to get more Tether into the trust, such as it is, so they can continue to collect interest on those Tether. And certainly there are interesting correlations between that going up and the MicroStrategy Bitcoin, the MicroStrategy issuance and purchases of things. MicroStrategy, similarly, he's trying to get as many assets into the trust, such as it is. But there's no mechanism to get them back out because the guy said he won't ever sell them. I mean, he no longer has 51% control and the rest of it. We'll see. But that multiple it'll probably go up more and it'll eventually come down. And it's going to be fascinating to see what happens there. But if you're left with a warrant for this company that was 50% out of the money when you bought it, but the multiple collapsed, right? It's now, 250% out of the money. 100, whatever. It's well out of the money. Yeah, that's not, we'll see. We'll see. People who sold Bitcoin options against it may actually end up money.
Possible. And on that note, happy Thanksgiving, everybody. We're still filming on Thanksgiving, so there you go. So have a great weekend. Thanks for all your likes, comments, subscriptions. We appreciate that. And we'll see you again next week. Bye-bye.